Right, welcome trader. Today I'm gonna give you my secret sauce. I'm gonna give you the my magnum opus of understanding the markets, and this will give you everything you really need to know to become profitable. Okay, so I'm gonna try and lay it all out there, and this just comes from years of figuring this out, struggling, so you can save a lot of time. If you're newer to trading and you don't fully understand everything that I'm going over, just keep coming back to this video and watch it again and again, and then look into certain parts, right? If I mention a specific strategy, I will have other videos specifically on that strategy, but this is the whole circle, the big enchilada of making money in the markets. And the way that you make money in the markets is you have more information and better confidence in where the market is going so that you can execute trades and get your little piece of different moves and make good money. Okay, and this isn't just about making a little bit of money. This is about changing your life. Okay, so my biggest thing when trading is I didn't get into trading just to make a little bit of money. I got into trading to make exponential gains and make a shitload of money. And because of my crazy investment of self into this market stuff, I get to give you a piece of what I've learned, and you get to take this and make your own money and change your life. Cool. So we're just going to get into it. So routines and basically, having a plan. So the morning routine, why is this so important? This is all for your mental, okay? If I were to ask you, do you believe that trading is mostly a mental or a physical or a tactical or a strategy thing, right? I would say 80% of people would say it's a mental game. So why aren't we investing more time into getting our mind right before we come to the markets, okay? If 90% of all traders fail, then we have to do what the 10% do. Okay, we have to be different. We can't do what the 90% do. We have to think different. We have to act different, okay? So the mental routine is do what you have to do in the morning to prepare for the markets. Okay, if you were a professional athlete, you wouldn't just roll out of bed and go onto the football field, right? Or go onto the tennis court or whatever. You would show up early. You would psych yourself up. You would listen to music. You would get into the right mindset. You would change your state. Because I mean, the reason that I use sports as an analogy is trading is a performance thing. You have to perform well. So in order to perform at your best, you have to have a morning routine. My whole routine is I have to eat a good meal the night before. Okay, so like I've noticed a lot that if I chug a bunch of beers and eat pizza or Taco Bell the night before, I'm not going to trade well in the morning. So I eat fish, I eat steak, I eat healthy the night before. I have to get at least 8 hours of sleep, right? Sometimes I need a little bit more than that, but like 8 is good. 7 is decent. Anything less than that, I really shouldn't trade. I wake up at 5 a.m. and I go to the gym. And again, I'm not going to the gym because I'm trying to get super shredded or super healthy. I'm doing it so that I can get the dust, the cobwebs out of my brain so that I can trade correct. Okay, so I mostly just stretch and then run, get my blood pumping. Sometimes I'll lift some weights, whatever I feel like doing. But that's also my time. I'm listening to an audiobook. I'm listening to like a podcast or something. I'm getting myself mentally prepared for the day. Okay, and then before I even take a look at the charts, I journal, and this is a handwritten journal. I don't, you don't have to do anything too crazy. I just go over my mantras. I just tell myself, I'm patient, I'm smart, and I execute like a professional. That's like really what I do. And I just check in with myself because I really want to, psych myself up. A couple things that I've been saying recently is like my grandfather would have killed to have this opportunity, right? Like if you think about your ancestors, like you get to click a button and make more money than they ever will. Like take advantage of this opportunity, okay? There's stuff like that. Like you got to have a winner's mindset, really. So I just journal before myself, and then I will step into the markets, okay? That's my morning routine, okay? That's just getting ready before the markets. After that, now it's my market routine, okay? And my pre-market routine is I'm basically marking up all the different levels. I'm really starting on the higher time frame, right? Like because I really want to get an idea of where we're going to go the next day, okay? But I'm just looking at key levels of interest, right? Come to the market, I mark up 4 hour, I mark up fair value gaps. I mark up the 1 hour, the day. Like you're just trying to get like your daily bias. Like what is your plan for the day? Usually it's an if this, then that, right? So this is what I would do. I would say, okay, so if we start to come back down, I would be very interested at what we do at the VWAP. I would also like to see what we do at this fair value gap, which is still here. And then also what we're going to do at this level of resistance, right? We hit this multiple times. Like this was the resistance, and then now it is the support. So there's a lot to the downside. I'd also maybe look for any psychological numbers. I would expect 200 maybe would be a psychological number, and even really 500 would be a big psychological number. Those are just, like a psychological number is like if I was, making a bet, what number would I want to get out of them? 200, 500, any of the hundreds are pretty on it, right? Next, you want to have your aftermarket plan. So after the trading day, you have to write down your data. Okay, so you either have to record yourself trading. You need to have some sort of software that's tracking your trading. We like TradeZella or FX Data, and you just need to have a way to go over what you did. Okay, real professionals watch the tape. Okay, real athletes spend time reviewing how they did that day. Because otherwise, if you don't even know what your problem is, and then you're not doing anything to fix it, why would you get better? So you need data. You need to analyze, what is your win risk to reward ratio? What are your winning streaks? Like how many trades have you done in a row that were winners? What are your losing streaks? How many trades in a row have you lost money on? How big is your biggest win? How big is your biggest loss? Like these are all really important things that you need to master, and you need to have your own system of something you can commit to. I recommend just record yourself trading, and then just open up a spreadsheet and just fill it out every day, right? And that's going to really help you kind of analyze what you did wrong, right? And you need to know what's going on. Okay, so that's just having a routine. Okay, so that's a big part of trading those. You have to have a routine. Okay, and remember, the reason you need to have a routine is because 90% of traders fail. Okay, some of them just roll out of bed. They're basically not disciplined. They're not getting their mindset right. Their alarm goes off and then they say, oh, now I got to trade, right? And they go to the computer in their pajamas. You have to be better than them. You have to be better, okay? You need to become the best version of yourself so that you can live the life that makes everybody jealous, okay? Next thing is you have to set your risk management before the trading day starts, okay? Like when you're still fresh, before you've started market, before you've even looked at the charts, you gotta just say, okay, I'm only willing to lose $1,000 today. If I lose more than $1,000, I'm gonna be pissed, right? I need to survive so I can stay in this game for the long run. Or you can say if I lose 2 trades, I'm done, right? If I lose 2 trades in a row, I'm stepping away from the computer for 24 hours. Okay, you need to have your rule, right? I think if you lose like either $1,000 or like 3 trades in a row, you're done for the day, right? You have to step away, and that's really going to just help you in the long run. Okay, a big, huge thing with trading is staying in the game long enough to make it to the big opportunities. Okay, if you're all out of ammo and the move finally comes, you're done. All right, you have to stay in the game as long as humanly possible to get to those winning seasons. Okay, that's a huge thing you really need to understand about trading. Okay, so yes, we want to keep trading. Yes, we want to keep making money, or we're gonna make it all back, we think, but set your risk management and step away. Okay, if you're doing prop firms and you blow an account, or you're already profitable in an account and you want to keep trading, go buy another account. Okay, but have a limit, have some sanity, some brackets where if you're just having an off day, like maybe you've never gone on tilt, but anybody who's traded long enough has gone on tilt, and it's ugly. It's a bloodbath, and it can all be saved by having a risk management plan before you start the trading day. Okay, that's very important. Before the day starts, not while you're trading. Okay, it's before you start trading. All right. This is a really big one too. This is this took me a long time to learn. Okay, and you have to do this. At least I had to do this. This was my biggest thing, was being patient for the setups. Okay? And the only way I was able to do this is I had to practice extreme patience. Like I had to have intention with practicing patience. Okay? And we're not just being patient for patience sake. We are being patient for A+ setups, for our key metrics to happen to be able to take a trade. Because when you first start trading, you're gambling. Okay, that's just like the first step, is just gambling. Okay, the next step is you become a sponge. Next step is you become a fighter. Then after that, you become like an oracle, right? You become a wizard. But I had to learn this the hard way, and I just want to save you years of struggle. And the biggest thing is, just think about this with me real quick. There are moments where the market makes moves where it is so blatantly obvious that we are either going up or down that anyone could get into the market and make money. Okay? The hard part is just being patient and waiting for those setups. There's also times where no matter what you do, buy, sell, like you're just going to get chopped to shit, right? And you have to learn to not get FOMO. You need to learn not to just jump into trades. You have to practice with intention that you are going to train yourself to be patient for your A+ setups. And here, the thing about trading is there's going to be another opportunity. The market's going to be there tomorrow. It's not the end of the world if you miss one trade, okay? Practice extreme patience. Become the Zen monk. Channel your inner Zen monk, and it will help you to become profitable and get to that freedom that trading can provide for you. But you have to practice it, and you have to hold yourself accountable. That's why we have the mentorship as well, so that we can hold each other accountable. And if we start FOMOing, I do it all the time still, but I have that mindset now where when I step to the markets, I tell myself, okay, I'm going to practice extreme patience today. And because of that practice, I have had some massive trades that have just like, they would not have probably happened if I had blown all my accounts before the perfect setup appeared, and it was very easy, and I didn't have to force the trade, and I was able to enter the trade, and then I was able to just let the market make me money. That's how you trade. You enter the trade at the right time, and you let the market make you money, right? You're not forcing it, you have no control, but you're letting the market make you money because you were patient for the right setup. Okay? Hope I drilled that home. Talk to yourself, have that inner dialogue that says, I'm going to intentionally practice extreme patience today. Okay? And then this is a big one too, that you're not going to understand at first, okay? But you're practicing patience because you're waiting for the right setups, and then when the right setups happen, you have to execute and trade large size. Yes. Even if you're not comfortable with large size yet, your winners have to be bigger than your losers. Your winners have to be substantially bigger than your losers. So if your average loser is $1,000, your winners should be $3,000 or $5,000, right? Or $1,500, but you have to trade large enough size that your winners make it so you can stay in the fight longer. And I know a lot of other traders or a lot of gurus will tell you, trade small, blah, blah, blah. But I didn't get into trading to make a little bit of money. I can do all kinds of things to go make a little bit of money. I don't wake up early and show up at my desk and, premeditate all this stuff just to make a little bit of money. I'm here to make a lot of money. I'm here to have exponential growth. I'm here to have hockey stick results. And in order to do that, you have to execute large trades. Now, you also have to protect the downside, okay? That comes back to the risk management and being smart, right? And if you're in the green, just go to break even. You can break even as many times as you want, not hurt your account, okay? So you have to, though, if you practice extreme patience, you wait for the right setup, and then you execute that right setup properly with a large size, this is going to change your life, okay? And this is really, really, really important. Even if like a large size to you is like 5 micros, like push yourself to enter into those. It can be large to you, but you always want to be trying to push yourself to not extreme uncomfortable, but to being uncomfortable, because winning is uncomfortable. Losing is uncomfortable. But choose your uncomfortableness. Choose, okay? Maybe you have a bad relationship with money. Maybe trading isn't for you. The only way you're really going to go into those deep questions and conversations in your mind and your psyche is if you practice taking large size trades, okay? And again, we're not taking dumb large size trades, and they could still go against you, so plan for that. But we are making sure that our winners are bigger than our losers. We have to. Otherwise you're gonna fade out. Like if you're gonna die by 1,000 paper cuts if all you do is profit $200 a day, right? Great, $200 a day, right? 20 days a month. Like that's pretty good money. But again, we didn't get into trading to make pretty good money. We are here to change our lives, to take care of our families, and to have freedom. And that requires bravery. And that requires trading large size. Okay? And again, we're not just randomly taking good side, like big trades. Okay, we're scaling into them. All right? And we're also practicing extreme patience. There's got to be some setup, some way that the market looks that you feel super confident putting large size on. That's what you're waiting for. And then this is a big rule, okay? We never add to losing trades. Never. Think about it. If 90% of all traders lose and only 10% win, I guarantee you almost 90% of traders are adding to losing trades, because that's how our minds are wired. Oh, it got cheaper. I'm going to add more. Oh, it got cheaper even more. I'm going to add another one. And then all of a sudden you blew it. So you never add to a losing trade. If your trade is in the red and you're adding to it, you are wrong. Okay? You always add to winning trades. Again, you have to break that common person thinking. You can't think like a common person. You have to think like an elite winner. Winners add to winning trades. Now, you're the only way you're going to feel confident trading large size, adding to winning trades, is if you have confidence in your understanding of the markets. And that will come with time, and that's kind of what we're going to get into next, okay? But these rules that I just told you have a routine. Set your risk management before the day starts. Practice extreme patience. Wait for the right setups and then execute with large size. Never add to a losing trade. Always add to a winning trade. And when I'm saying add to a winning trade, you should like start with 3 contracts, add 2 at a good level, and then add another 2. And then if it starts to go against you, get out. But you want to make as much money as possible when you hit those winning trades that just keep going, okay? Like, because again, and never let a green trade turn red. Just go to break even as soon as you want. Never move your stop loss until you have solid momentum. But once you do see good momentum, move your stop loss. Okay, that's kind of my rule of thumb, at least. Now we'll get into actual trading wisdom. Okay, so master the higher time frames. Okay, the higher time frames is everything. The higher time frame dictates. All right, the 1 minute is just noise, but the higher time frame is the end all be all, everything you need to know about the markets. Okay, and you're going to use these practices. I'm on replay mode. I'm just showing you the higher time frames. Okay, well, like what if we even go even higher? You can even go to like the month. And the cool thing about like going back to the months is you'll see we almost never have 3 red months or a 4th red month. I think if you have 4 red months, it indicates that we're in a recession, right? So always if you see a red month or 3 red months, the next month is probably going to be a big old green candle. Boom, right? Never seen 4. Here's almost 4, and then little tiny green one. Right, so it's just kind of like this is just kind of oh, here we go. This was in 2000. We had 4 red months, and then a green one. Boop. But it's very unlikely, right? And so you can start to see. Okay, so there's some patterns. Like this month has been crazy. Look at this. What is it? This was August. So August so far. Okay, my bad. We're back testing. Huge wick. Those wicks, we don't see those kinds of wicks very often. So like we kind of went down and then we went right back up. Very, very interesting. And this was on the month of August, okay? And then let's go down to the week. We've had, 3 red weeks. Probably going to get a green one, right? Not very often do you have 4 or 5 red weeks, right? So this is just kind of how you can get it. Because look, if you can determine on the higher time frame which direction it's going, you're really just going to want to take those trades. It's just a hack. It just makes everything better because there's going to be bigger moves for those trades, right? So always try and game plan on the higher time frames, okay? And then kind of zoom in and make your battle plan. So we've had some pretty down times, right? We're pretty much right at this draw on liquidity. Like I would expect us to, maybe come all the way down here. Maybe we can go even lower. But also we just hit this like fair value gap right here from this day. We bounced pretty hard. Like that was a pretty solid fair value gap. Also, it looks like it was like a flat candle almost. No, not quite. But you'll also see like we kind of had like this dump. We came back here. We tried to go higher and we rejected hard. So the downward momentum is still pretty strong. So that's kind of interesting. So that's on the daily. Let's go down to the 4 hour now. Very aggressive to the downside here. And like there is this this was a consolidation zone. The market always goes in 3 movements. It's expansion, manipulation, consolidation. We had this consolidation zone like right here, which is pretty much right where we tapped into. So in order for us to break through this, we would have to have some serious momentum. So probably gonna bounce to the upside. Also, we have this big fair value gap that we have not really filled. We also have, this fair value gap right here, that has not been filled. This is still pretty wide open. And we really just formed this new fair value gap on the 4 hour. So I would expect us to at least bounce back to about 50% of this range. And we're going to go down to the hour. We're going to look even further into this. Really probably move it to like the tips of like this and this right here. A lot of this time, there's a lot of liquidity right at the tips of these. So definitely expecting us to bounce back. And if we break through this fair value gap, I would expect us to go to the upside. If we bounce off of this fair value gap, then we're going to have a continuation to the downside. 15-minute. And now we're looking at the ranges of what we had the day before, right? So I'm kind of marking up what we did. So here's kind of our range right here. Let's just go to the open now. See what happens. Higher time frame. So I use the higher time frame to mark up my charts. So now I have an idea. Okay, so areas of interest are going to be this little golden zone right here. See what we do off of the golden zone. And then if we break down lower, it's going to be a very red day, right? So what I want to see is us pull. It's an if then that situation. Okay, so if we break up here to this golden zone, and we break out, we're going much higher. But if we hit this golden zone and then we bounce to the downside, I'm going to be looking for an inverse fair value gap right at this little golden zone, basically. So let's see what happens. So we never even made it up to the golden zone. We started to break lower. Very, very bearish looking here. Super just like trendy right here, right? We just dumped and we never even tried to go back up. So we're definitely going down, down, down. And we went right through both of my levels. So that means we're going to keep going lower, probably to here, or we might go here. I mean, the real liquidity would be way down here, right? If we go all the way down here, I'd definitely be looking for a reversal at that point. So let's see what happens. Blam! Look at that. Look at that, though, guys. I called it. Look at it. Right to this line. Why? Because we had extreme liquidity down here. So the pull to that was big. And then we hit that, and we had this big old fair value gap. And then we hit it again, and on the second one, we bounced. Right? But this is how you master going from the higher time frames down to the lower time frames to make your strategy. Look, we had this, we came all the way down, just dump. We hit this level right where I thought we would, pretty much. Again, we bounced off of it. We also formed this fair value gap. So, I probably would have thought we would have gone long here, right? But then we formed another inverse fair value gap right here. So this is just super, super bullish right from the jump. So we'll just buy. Really, like, our TP ideally would be up here at the Asia high, but that's huge, right? And we'll put our stop loss just below this one. Well, we'll see what happens here. Boom, 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 boom. straight to take profit, 40 grand. Crazy. 3 contracts, right? Anyways, the idea though is like you go from the higher time frames and you mark out the levels of interest, okay? The key levels. And you can also see like we hit this level right here and we bounced off of it, came back down to VWAP, continued to the upside. But because we had this fair value gap here, right, in this green candle that we still haven't filled, which means we might come back down and fill this fair value gap. It really just depends on what we do from here. But what I did is I used the different levels on the higher time frame as a draw on liquidity of where I thought the market was going to go. Okay, so master the higher time frame. Like the biggest things you're looking for in the higher time frame are going to be fair value gaps, large wicks, like manipulation candles, flat candles, gaps. Any of these things, you need to mark them up as a key level on the charts for the day up if it's going to be relevant, right? It has to be relevant. So like when we go back here, if we go back and we're looking at, the 4-hour chart, what are we looking at right here? So big wick. Look at that. We went right to 50% of this. So this is what a fair value gap is. It's just where there's a large candle without any pullback. We went pretty much right to 50% and bounced off of it. There's a couple more like little baby fair value gaps, like right there, all the way up here. Other things you're going to look at is like this is an order block. So this green candle is an order block. A lot of times we'll hit the order block and then bounce off. And then if you go all the way back over here, there's probably like this fair value gap never really got filled. So that's kind of like right. We went right through that and we filled it. And then these wicks down here had a lot of contracts just sitting. So there's a lot of liquidity there. But now that we've kind of had a change in state, like the liquidity is really way up here now. And when I say liquidity, it just means there's a lot of orders back up here that are hanging out. But we also have this huge range of consolidation that we went into before we dumped, right? So I predict like we'll either go lower or we'll go all the way back up here and then we'll kind of bounce around for a little while and then probably continue to the upside. But look, so like the idea of the draw on liquidity is if I can predict where the market is going, this will make your life so much easier because we're most likely going up here, right? Now these 2 red candles or these couple red candle days, like those would have been hard to tell, and we chopped around for a while here, but then we broke down, we went back into this basically like little fair value gap range, and then we continued to the upside with these 2 green days. That would tell us, okay, we're going up, right? So we have to wait around a couple days before we catch the big move up, but we at least know it's coming, and we know that there's liquidity up here, and we also know like there's a lot of consolidation here. So we're probably going to hit this range and chop around for a little bit before we continue higher. Boom, just like I said, chop, chop, chop a little bit higher. And this is the 4-hour candle. So each one of these candles is huge. So really the best setup on this whole thing was this inverse fair value gap right here. So let's go back. So these are examples of reverse fair value gaps. So you have these big red candles down, big green candles up. This creates this fair value gap. I mean, there's one right here and there's one right here. So like 50% of the range almost always gets retraced, and then that'll tell you if it just blows right through this, that means we're going down. But if we tap into it and then we bounce out, that means we're going higher. So like if we would have caught this wick right here, we would have been set for life. And then also this one right here, red candle, back to green, buy, we know we're going higher from here basically. And we're billionaires. But anyways, this fair value gap held, and then we continue to the upside on our drawn liquidity, which, there's probably a lot of action going on right in the middle of this big red bar, but we're really getting pulled all the way back up here, right? So let's see what happens when we hit this. Oh, we smoked right through it, which means we're going higher. Went right to that range, and boom, that's where it really wanted to go. Now it's going to chop around, and now it's kind of dumping. So that is the perfect example of using the higher time frames, and then to kind of figure out where the draw on liquidity. And the draw on liquidity just means where is the market going. Once you master looking at the charts and being able to say where is the market going, it's gonna change your life, because that's what we're doing. That's what we do all day, is we predict where the market's going and then we take trades. So mastering draw on liquidity. The liquidity is always just at these areas of manipulation where like we changed, right? Where we did something. It's either a fair value gap, big wick, right? It's just like the momentum and where the price action is moving things to. So like now we're kind of in like a sideways position, but it's again, it's an if that scenario. So if we start keep cooking, we're going up here, and then we're really going up here where the serious liquidity is. This is really where the market wants to get back to. This is where all the action was, where we had all this chop, and then all-time highs is basically the premium, right? Everybody bought down here, it was in discount. Up here is kind of the premium, and we want to go back up to premium, but we still have to, probably fill, this fair value gap, and maybe even this lower fair value gap, even lower down here. So it's an if this, then that. So if we start to go down, then we're going all the way down here. But if we start to go up, we're going all the way up here. But you have to look at the market, right? We had this big move to the upside. We've kind of formed this like bear flag now. This fair value gap, boom, got respected. So it hit the middle of this red candle bar, broke even lower. Okay, hit the middle of this red candle bar, broke even lower. This right here, on the other hand, though, we've now broken the trend. We've now broken the method of the madness, right? We're now in a choppy range where the market doesn't know what it wants to do. Now, a lot of the times you'll break the trend and then it'll pull back and push through, but most of the time it wants to go higher. But these are the ranges we don't want to trade. If we can see clearly, though, we are in a bearish trend, that's when we want to get in. But once it breaks this trend, we want to wait for the market to decide what we're doing. Like right now, this fair value gap right here, this one got respected and we're going higher. So we probably will just continue to the upside, but we want it to confirm more than just one time, okay? Because you can see it's just in this little choppy range now. So we really want to be patient. And then once it confirms to us, oh, look at that, we're going down. So you never want to trade, or you never really want to you still want to trade, but you don't want to guess when it's not clearly presenting to you the opportunity, right? When it's clearly presenting to you the opportunity, that's when you make a lot of money. But if you don't know and you're in a state of confusion and you're just hoping, that's when you lose all your money, okay? Market doesn't give a shit about you, but if you can accurately see the trend, you're going to make a lot of money, okay? So you can see this trend, red candlestick, respects the fair value gap, more red, respects back into the fair value gap, more red, and then here we go right through it. So it no longer is respecting the downward trend. We go into this weird choppy state, but then we decide, okay, we are going to keep going lower. And look, we came right down to this level, right? We're to this fair value gap, like I said. So the draw on liquidity was, oh, look, we broke through this, so then we're going down to this level. Now, we have to see what happens at this fair value gap, if it's going to respect it or going to go higher. We'll see. Okay, so that wick respected it, and then boom, we broke down even lower. So we're still in a downward trend, but now we just broke it again, so we're still not really sure if we're going to go higher. Oh, there we go. Now we're going higher, right? So we can buy blah, blah, blah. And we're going higher. All the way up, all the way up. So this will be our biggest exit right there, but we might even go all the way up to here like I was saying. But now you have an idea of how to master the higher time frames and how to start analyzing for the draw on liquidity. Okay, you go to the higher time frames and you map out for the 4-hour fair value gap. You map out, where we our pivot points, right, where we flipped. Also, you're also marking out the areas where there's manipulation candles. You're marking out the areas where there's consolidation, right? But you're just using your common sense to say, okay, we moved through these areas really fast, but we stopped around here. So there's a lot of orders probably still sitting here because people got chopped, or people's stop losses are here, or the market is super efficient. We want to go back and fill those efficiencies. That's why they fill fair value gaps, so on and so forth. And it's just a magnet for the markets to go up there and get those contracts, and it's like trying to go get them, right? We tried here, we did not quite make it. We came back down, we returned to this high, and now we're going to go for it, right? See if we get a little closer. Boom, we finally hit that fair value gap, or that exit, and then it immediately reverses. We hit the liquidity and then we ditch, right? That's what happens. Okay. So master identifying the market and those key levels. Okay, so the key levels again are where we have these consolidation periods where it's just sideways, right? So the market is power of 3, right? Manipulation candle, right? Here's a little manipulation candle. We try to go higher, manipulation. Then we had an expansion. Then we have a consolidation, a little consolidation, manipulation candle here in the middle. came back down, a little more consolidation, expansion. Okay, and then consolidation, try to break out, manipulation candle, expansion. So we're always going in the power of 3. But the key things you're always marking out, because again, they're like magnets, are manipulation candles, fair value gaps, where there's a gap that has the orders have not been filled. These are like magnets, draw on liquidity. And then there's also other ones like gaps in the market always get filled, flat candlesticks always get filled for some reason. They always come back to them. So just things like that. And you want to mark those as key levels. And then when they hit those key levels, you're looking for inverse fair value gaps. That's literally the whole strategy that's going to make you like $1 billion is, number one, understand that the market kind of moves when it's moving correctly, right? It moves in these little cups, right? So we came down here, we printed this big old fair value gap, and then we immediately returned. We made our own fair value gaps to the upside, and then those spots were respected. Really, it's like this, and you'll see it on all the time frames though. Like you see how we have these big fair value gaps, and then we have these big fair value gaps. So it's like if there's a fair value gap going one way, and then a fair value gap going the other way, we're going to bounce back into that fair value gap, and that's going to give you the key determination of what the market is doing. So now, right here, we came back into this range pretty much. This fair value gap right here, 50%, we bounced off of it. We can try a buy here. Blam! Up. But we had a big pump, and then we had a reversal, and then we had the same thing again. So this is where the market is kind of fighting and trying to figure out what it's doing, right? But we're still respecting this low that we had here. Boom, boom, boom. So anyways, we saw this fair value gap, and then this one again, inverse fair value gap. And then we had this big green candle, and you see we came right down to 50% of this candle. Right down to it. And then we went higher. So that's our confirmation that we're going to a higher state, because if the fair value gap got broken, would mean we're going down, right? And then you'll see it happen again here. So we have this big fair value gap, pulls back into it. This time it broke the fair value gap, and then it bounced out. So it's not 100%, but like you see how on this time this was almost a reversal to the downside, but it did not close below the bottom of the fair value gap, or it did wick to it though. So it wicked pretty hard right to the bottom, like right there. We probably would have gotten stopped out if we entered into this trade, but if we would have been like down here where we first saw it, it just keeps going upside now. And like the biggest thing you're using these for is it will tell you what direction the market is going by how they are respecting the fair value gaps. Very, very powerful, incredibly powerful. You'll have to make another video just on mastering fair value gaps and inverse fair value gaps, but you're really looking at these key levels and then how the market reacts at these key levels, because that's going to tell you where it's going to go. So once it hits these key levels, if it forms an inverse fair value gap, that means that we're going to go in the opposite direction, right? If it creates a fair value gap, it comes back into it and respects it, it means we're going to continue. All right, and we got to get big face for this. All right, so let's set up our Fibonacci things for this next one. Okay, so you see how we had this big, fair value gap here on this side, right? And then we basically tried to respect it, but we went right through it. Then we formed this fair value gap, but we had so much momentum that we formed another fair value gap, and the market came down to this one right here, right into the 50% or about 50% of this range, and we just took off. So that would have been our key indicator that we're probably going to go higher. But you also got to look on this side, right? There's some interesting levels all the way over here that we're probably going to go to. So that would kind of be our draw on liquidity. We're probably going to go there, and we want to see how the market reacts once we get there. Boom, we hit it. And it wasn't like a hard, usually if we hit our key levels and then we bounce around a little bit, you want to be cautious. But if we just go right through it like butter, that usually is a good sign that we're going to continue to the upside. So we'll see. Boom, boom, boom. Slow grind day all the way up, and into the freaking. This would have been a huge day. But we can also take a look at this. Well, this one probably wouldn't be a good example for the Fibonacci. Okay, so I don't know if you've watched my videos yet on the Fibonacci, but the Fibonacci, every day, I just do it from whatever the London or the Asia high was. That's where I go. Okay, and you can see like the golden zone was struck pretty much back here, 5 in the morning. So I was not been a bit awake, but as soon as we hit this level here, We hit it, we kind of bounced off, but then we formed a new fair value gap, and we saw that we were breaking to the upside from this. We'd have been able to just get in there long, and then you can see we literally go all the way up to the extreme of the negative 1.8, which is the Fibonacci numbers. And then, I mean, I think we probably keep going up even, but we literally bounce off of that. But that's an extreme. That doesn't happen every day. I think it's probably going to maybe keep going through that. But you see how that random Fibonacci number now became resistance? It's kind of interesting. But we're always looking for this golden zone. What happened at the golden zone? Because look, biggest reason that this whole system works, okay, so try and stay with me here, is we have these two key levels from the day before, okay? And we also kind of want to look at New York's levels from the day before as well, the previous day's high, previous day low. But we have the top of the Fibonacci is 0, and the bottom of the Fibonacci is 1 of the range between Asia and London the day before, or the 2 sessions before. So what I'm trying to say is both of these are key levels of interest, okay? And they are draws on liquidity, okay? So if the middle zone is the golden ratio, right? And also all of the big hedge fund people also think they're super fancy and smart, so they probably use Fibonacci as well. But if we pull back into the fib or into the golden zone, right? And then we break out of it, there's like an 80% chance that we're going to go to at least this level, right? And then once we get to the high, now we watch what the market does at this level, okay? We really like when we see this like cup pattern again, where we have this fair value gap down, fair value gap up, taps back in, confirmation on the direction of the move, okay? But the fib is just added clarification. It just helps you to stay in trades longer, helps you to confirm key levels of interest, and watch my video on the whole Fibonacci, but it's really important. So mastering the fair value gaps and the inverse fair value gaps is first, right? That's the big thing. Like fair value gaps are magnets. The inverse fair value gaps, where you have a fair value gap one direction and then another fair value gap, and then we tap back in, that tells you it either is respecting that levels and now that's a new direction, or it is rejecting those levels or disrespecting the fair value gap, and that is another key level of information. Mastering the Fibonacci. So again, I like to do the fibs on the Asia and London range highs and lows of the previous session. But the other way that the fib really, really works is if you do it from manipulation to manipulation, okay? Because again, the markets move in waves of 3, like the power of 3. They move in consolidation, expansion, manipulation. So like whenever there's 2 manipulation candles, the fib works really well for some reason. And it's just like you kind of want to also look at your higher time frames. And you're looking for, and like I consider manipulation like these big red candle, big green candle, or these really big wicks that just wick out basically. This little manipulation candle to this manipulation candle. Right, we already kind of broke out of it, but like we came right down to the 608, so we have a very high chance of going up to this, TP, which is like right there. So let's see what happens. Bam! Did you see that? We went right to it, and then we tanked down. That was pretty wild. So then we would move our fib from, to this candle down to this candle. And the golden zone just tells us, like, once we hit the golden zone, if we hit it and bounce off, we're going down to 0. If we go right through it and we have confirmation that we're going higher, we're going to the 1. And those hit about 80% of the time. But it's also a great way to catch a trend, right? And hold for longer trades, which is pretty cool. We hit the top. Pretty good chance. I'm going down to here now. And you put your stop loss up here. Obviously negative risk to reward, but whatever. Boom, straight to take profit. The Fibonacci it's just added confirmation. It's a winning strategy. The real thing I want you to understand though is to use these strategies not as the end all be all, but to give you a clearer view of what is moving the market, where the market is moving next. Okay, draw on liquidities, fair value gaps, inverse fair value gaps, the Fibonacci codes. These are the tricks to these are the keys to the castle. These will tell you everything that the market is doing of sideways, right? So let's see if it did it. Well, it did it pre-market basically. So first thing we did is we took out the the low, and then we took out the high of this sideways Asia London session. Always, like almost always happens. It's very, very cool to have something that happens so often. But like whenever you see these sideways, just expect the market to zigzag the same thing. It's kind of interesting. All right, and then honorable mention, the VWAP is very powerful, and so is the orb. But really, just mastering fair value gaps and the Fibonacci is going to make you a profitable trader. Hope this was helpful, and I will talk to you in the next one.